What I have for you today is an interesting case about the boundaries, as far as I'm concerned, of Chapter 6 and the idea that the legal owner cannot retain all income if it does not perform all functions. So what we have here is we've got wholesalers selling all kinds of pesticides and the like to farmers through distributors and retailers. And then you had a Canadian group, AgraCity, which actually cut out the middlemen and helped Canadian farmers buy these things much cheaper than they would otherwise. So the case is AgraCity Limited and versus the Queen. It was before the Tax Court of Canada, and let us look and see what's going on. The case is quite fact dense. This is the product that it was about. It was about Clear Out. That's not sold anymore, and this wasn't sold by AgraCity, but it's the only picture that I could find of Clear Out itself. And let's dive into the facts. Before we do, I want to give you the following to consider as we look at this case. Imagine you have a company, a parent company, and it has lots of subsidiaries and it has lots of real estate everywhere. It makes stuff, it sells stuff, etc., but it decides to put all its real estate into one separate company. That company has no personnel because it doesn't need it, but it leases the real estate to the parent company, and either the parent company or a sister company provides all the services that the real estate company need. It takes care of the maintenance of the building, of the lease contracts, of everything else. And now the question is, how would you deal with this? Under Chapter 6, I know it applies to intangibles, but I think the doctrine could equally be applicable to tangibles. If the real estate company has no one to perform any functions, but it is the legal owner of the real estate, arguably all the income from the real estate should go to it, but then almost all of that income should subsequently be passed on to whoever is performing all the functions for the real estate company, such as the leases, such as the maintenance, such as the rent increases, legal disputes, all that kind of stuff, so that the real estate company itself only holds or keeps a very low return, basically for financing the real estate, most likely. Now, let's assume that the real estate is sold 20 years later, and there's a huge gain on the real estate. The question is, who should that gain go to? The gain is primarily a function of inflation and of the real estate market skyrocketing. It's got nothing to do with what the parent company did. It's got nothing to do with what the real estate company did. It's purely a function of the market and inflation. At most, one can say that the parent found a buyer, which is not very difficult in a hot market, and the parent arranged the sale. So maybe the parent should get payment equal to what you would pay a real estate agent. I think that would be an arm's length compensation. So is the real estate company entitled to keep the rest of the gain? I think the answer logically is yes. I'm not sure that the answer is yes under Chapter 6. And I think our case has something in common with this example. So let's look at the facts. We have the F&A group of companies. That's the Farmers of North America. It was described as by its founder, James Mann, as a business alliance of farmers across Canada and parts of the United States designed to change how markets function in order to increase farmer profitability. Right, so there was a whole lot of issues in buying fertilizer and pesticides and all this stuff, and a lot of middlemen earning a lot of money. And these guys who were farmers themselves, James and his brother, decided we're going to cut this out. We're going to make the stream much shorter, as you can see in the drawing on the background, and we're going to help Canadian farmers earn a lot more money. F&A strategy is to achieve its objectives on behalf of its membership. It is a membership organization. F&A is a member and membership services-based organization. Virtually all of its revenues come from selling memberships to its members. Where the F&A group provides products, commodities, or services to members, those are promoted by F&A but are provided through separate F&A group companies. And these make a small but reasonable profit, as we'll see. Now, one of the products was glyphosate-based herbicides, right? So in Canada, glyphosate herbicide such as Clear Out, that we just saw, are subject to the Federal Pest Management Control Act, which is administered by the PMRA. We'll see this name come back. The sale, distribution, and use of regulated products such as glyphosate-based herbicides, including Clear Out in Canada, requires that the particular product itself be registered. Registration in Canada is a lengthy, detailed, and complicated process, as one would expect, requiring chemical evaluations of the glyphosate. So if you're a simple farmer, and I'm using simple with respect here, going through all this admin individually is a nightmare, and that's where the Mann brothers came in and they helped. They said following their extensive consultations, the Manns and the FNA understood that Clear Out and the OUI program could be promoted by FNA to its members. So what they said is, instead of everyone individually importing this stuff from the US, let us do it on behalf of the farmers altogether. We become specialists in the admin. We reduce the admin because we can do it in large volumes per term, etc., etc. But as I spoke to the authorities, one thing that was very clear, and that's the pink part here, is it remained forbidden for anyone to offer Clear Out for sale in Canada or to sell it in Canada. And the rule basically was under the OUI program in which you imported this stuff. If you were resident in Canada, you could promote this stuff, but you could not sell it. So you need to find someone else outside of Canada to sell it to the farmers, right? You can promote it, but you can't sell it. Further, they understood from PMRA consultants, materials, and meetings that this meant that their members would have to purchase the Clear Out from a non-Canadian supplier outside Canada. This is tantamount to the case. To this end, in 2005, James Mann caused a new US corporation, New AGCO Inc., New AGCO US, to be established in the state of Delaware to be used to purchase the Clear Out in the US markets, to warehouse it in its rented warehouse facilities in North Dakota, and then to sell it to FNA members, right? And then they scaled this up and they said, in that year, New AGCO sourced its Clear Out in the US from a large number of suppliers, with Clear Out available at a fraction of the price that glyphosate herbicides were selling in Canada. So they got it much cheaper. In other words, there were a lot of Canadian middlemen making a lot of money. Their suppliers included Chemical Products Technology, CPT, who was then the manufacturer of Clear Out, and who later sold those rights to Albach. So we'll get back to Albach later, but this was one of the main suppliers for, CPT was the main supplier for this herbicide. New AGCO sold Clear Out to individual FNA members, free on board, to their individual farms in Canada. New AGCO US typically purchased the Clear Out from its US suppliers, including CPT, in large quantities. You get the benefits, paid for them upon purchase, and arranged for it to be delivered by transport truck to their US warehouse facility. From their individual containers, being either totes of 1,000 liters or drums of 200 liters, would be specifically identified as having been purchased by specific purchasers, Canadian purchasers, and each purchase Canadian labels would be affixed. You had to have the labels. It could only be per one buyer at a time, and this is how you had to get it across the border, right? So then each one had their individual OUI permit and custom forms. New AGCO US would arrange and pay for third-party truck transportation to the Canadian buyers, and after a short time, New AGCO US engaged third-party customers, brokers, to clear the custom on behalf of each individual purchaser, and that purchases a Clear Out account. So they outsourced things, and they got trucks, third-party trucking companies to take this, and the number of truckloads measured in the hundreds. So these brothers found something that was a good business opportunity, and their business grew exponentially. And even today, if you go onto AgraCity's website, it is an impressive company. It's an impressive group. They sell far more products today, and these guys, one would almost say, lucked out and pursued the opportunity, and good for them, right? So New AGCO used AgraCity to attend to the logistical and related activities of its sales and deliveries to its Canadian buyers. So you had the Farmers of North America group. It had a Canadian subsidiary, AgraCity, which is also the taxpayer and defender in this case. And AgraCity did basically all the work. New AGCO US was more or less a shell company that bought the stuff in the US and sold it, but most of the backup work was done through AgraCity. This is the way I read the facts. Maybe New ACCO US had 1 or 2 employees, but I don't think a lot more. This was set out, this agreement between AgraCity and New ACCO US for the services was set out in a written service agreement between these two corporations. Under its terms, AgraCity was paid an amount per liter of clear out sold to perform these services. That amount was revised and adjusted upwards twice between 2005 and 2007 to ensure it was and remained profitable for AgraCity to do this job, right? AgraCity in practice earned, it showed later in the case, around 12% cost plus for their services. AgraCity and its staff would coordinate the Farmers North America's orders, and other farmer F&A staff, once an order for clear out was placed with F&A by a member, to attend all of the purchase, import, customs work, labeling, arrangement payment, and delivery. F&A would promote the availability of clear out at a price per liter fixed by New ACCO US and communicated this to the F&A. So you had this US company, it bought the stuff, it sold it to Canada as it should, because no one in Canada was allowed to sell it. But the guys, F&A in Canada, did promote the clear out, obviously. And then things changed. 2006, they decide, you know what, instead of using a US company, let's use a Barbados company. And this is where things go wrong, right? In December 2005, CPT sold the clear out rights and inventory, etc. to Albach. Remember, we saw them before, which already had its own glyphosate-based products. I cannot say that name, glyphosate. This was the first the Mann brothers had heard of Albach, so they didn't know before. Jason Mann promptly set about persuading Spencer Vance at Albach to sell clear out to New ACCO Barbados. In negotiation between Spencer Vance and Jason Mann in late 2005, New ACCO Barbados got an exclusive supply agreement from Albach. So only New ACCO could sell clear out in Canada. That's the way I understand it. The structure put in place and used in 2005 continued largely unchanged, except that New ACCO Barbados incorporated in March 2006 to take on the role of New ACCO US. So at the time when the contract with Albach was negotiated, New ACCO Barbados did not exist yet, right? But when it did, it took that contract, and now you got to think a little bit back to the Cameco case. We had something similar, also a Canadian case, where a contract with a lot of potential was transferred, right? Maybe in this case even more potential than was in the case of Cameco. So New ACCO US orders from F&A members were transferred to New ACCO Barbados. Albach became the virtual sole supplier to New ACCO Barbados of clear out under its exclusive supply agreement. And then 57, after the end of 2005 agricultural season, before the 2006 one, the Mann brothers decided to transfer the New ACCO US Canadian clear out sales business to a new corporation to be incorporated in Barbados. This was done primarily to minimize the US tax payable on the sales of the profits, because New ACCO US obviously had to pay tax. And they did this through asset sale. But remember, this was done to save US tax, not Canadian tax, right? Jason Mann continued to buy all available clear out for New ACCO Barbados as he had before for New ACCO US. The price for clear out to Canadian farmers continued to be determined by Jason Mann for New ACCO Barbados as its costs from Albach from time to time, plus a reasonable margin for expenses and profit. And then AgraCity had entered into a service agreement with New ACCO Inc., a non-arm's length Barbados International Business Corporation, in the years in question in connection with the sale by New ACCO Barbados directly to Canadian farmers the use of glyphosate-based herbicide, right? So that part is there as well. In reassessing AgraCity for its 2007 and 2008 tax years, this is what the Canadian Tax Authority said. The Canadian Revenue Authority relied upon the transfer pricing rules in the Canadian Act and reallocated an amount equal to the New ACCO Barbados profits from these sales activities to AgraCity. So basically what the CRA said was that all the income all the profit that was made in Barbados always belonged to AgraCity in Canada, and the New ACCO Barbados should have gotten none of it, right? It went as far as calling the transaction a sham, And it says in paragraph 19 of the amended reply by CRA, it says the series of transactions entered into by AgraCity amounts to a sham or window dressing designed to deceive the Minister of Finance, I guess, or of Taxation in Canada, into concluding that New Echo Barbados, not AgraCity, was undertaking a business in incurring real risk. And accordingly, the profit from the series in the amount of 2.4 million and 3.7 million are properly included in AgraCity's income for tax years 2007 2008, right? This rolled forwards from 2006 onward. And then we have, and now we come to the chapter 6 thinking, right? Where we have a government expert, Oliver Rogerson. Mr. Rogerson was called by the respondent as an expert in the economic analysis of transfer pricing. Mr. Rogerson was a Canadian delegate to the OECD Working Party 6, responsible for updating and maintaining the transfer pricing guidelines, which are the extended commentary to Article 9 of the OECD Common Model Tax dealing with transfer pricing. And I think I've actually met Oliver when I was delegate for the Danish government during the BEPS years. And this is what his report said. He's been at the OECD representing Canada for a very long time, both before and after BEPS, it seems. And his economic transfer pricing report says a number of things. First, he was provided with the following assumptions. One, Jason Mann negotiated the price for a clear-out products with the suppliers, right? So with Allbach. The F&I staff were establishing the pricing for clear-out. They said that's what really happened. New Echo Barbados was the entity contractually selling the clear-out to Canadian pharmacy, contractually acquiring the clear-out and making the payments for clear-out and for transportation of clear-out. So New Echo Barbados was involved in all the financial transactions, right? The decision-making process for New Echo Barbados was made in Canada by James Mann and Jason Mann. And Jason Mann had the sole signing powers in respect of New Echo Barbados. What I find interesting about this case is why they made it a transfer pricing case only and why they didn't argue that New Echo Barbados was a tax resident of Canada. But I guess that has some specific Canadian reasons. And then Mr. Rogerson went on to state, as part of his understanding of the commercial and financial relations and his functional analysis, and now we are very, very much looking chapter 6 style thinking, right? New Echo Barbados had no employees and therefore no ability to perform any functions. Therefore, next bullet, there was no opportunity for New Echo Barbados to add value in the transaction or extract value from AgraCity. Okay. While New Echo Barbados is contractually involved in the transactions, the functions required to carry out the clear-out transactions are all performed by other parties. This sounds very much like chapter 6 and legal ownership and functions performed, right? The least complex entity between AgraCity and New Echo Barbados is New Echo Barbados, as it performs no functions, uses no assets, and takes no risks. This is what Rogerson said. New Echo Barbados performs no functions and is not able to either generate nor retain, again chapter 6, any value or for itself in the context of an arm's length transfer pricing analysis. Mr. Rogerson testified that in forming his opinion, he did understand that clear-out had to be sold to Canadians by a non-Canadian. And what he said is, this is exactly what New Echo Barbados' role was. It was a legal shell outside of Canada, which allowed the farmers of North America to sell the clear-out in Canada. It was only a shell. It only lent its shell for the transactions. Everything else was done in Canada and therefore should have been taxed in Canada, right? But then the lawyers for AgraCity convinces him slightly differently, although he doesn't admit to it completely in court. He says in his cross-examination, appellant's counsel put Mr. Rogerson 3 propositions. 1, neither AgraCity nor FNA nor any other Canadian entity could lawfully sell clear-out to FNA's Canadian members, even through a US branch, and that was quite clear. And then there was some other obvious point. And then point 3 is also important in our case here. New Echo Barbados effectively had a monopoly on US clear-out, having negotiated with Allbach a supply agreement for 95% of Allbach's production. And it was at the same time actively buying out other available clear-out in the US, because the Canadian farmers were using a lot of clear-out. I mean, the US farmers in the beginning of the setup actually ran out of clear-out because the FNA was buying all the clear out that they could find, right? So in those circumstances, Mr. Rogerson agreed that if those facts were correct, they do create value in New ACCO Barbados, and that would have to be looked at in a functional analysis, because New ACCO controlled the supply chain and had total access to the demand pool, right? So obviously it brought something to the table of value. It just didn't have any people to exploit that value. And the court, in the end, shoots down Revenue Canada and says, you know, we go with the taxpayer, because even though this was an empty legal shell, the Barbados company did have assets, it did have a contract, it did run risk, it bought in dollars, it sold in US dollars, it sold in Canadian dollars, it took care of transportation, of insurance, of warehousing, all that stuff. All of this cost money, and if anything went wrong, it was on the account of the Barbados company, not the US companies, right? And therefore the court says, this court has found that the clear out purchase, sale and related transactions were not a sham, nor was any individual transaction in a series of transactions beginning with the incorporation of New ACCO Barbados for the clear out sales activity a sham. The transactions that occurred and were documented were the transactions the parties intended, agreed to, and the parties reported to others, including the CRA. Any shortcomings in any paperwork was not intended by the appellant or anyone else in the FNA group to receive the CRA. What Revenue Canada did was they found a few invoices, or maybe many, where actually the address for the Barbados company was in Canada, not in Barbados. They found that there were sometimes invoices were addressed to companies that had something in the Barbados company's name wrong, so therefore it couldn't have been a Barbados company. A bit formalistic, but in other courts this might have succeeded, but the judge looks through that in this case, and he says this court has found that, one, in 2005 New ACCO US was chosen to be the purchaser and seller of clear out, because it was generally understood by James Mann and others involved in the FNA group that a non-Canadian entity was required under the OUI program, as administered by the PMRA under the PMCA, and that FNA could only promote clear-out's availability under the program to its members and its potential members. It couldn't sell it, right? Further, I find their understanding was a reasonable one in the circumstances. This understanding was unchanged when New ACCO's business was transferred from New ACCO Barbados early in 2006. And part of the judge's reasoning is that, you know, CRA did not attack the structure as long as it was run by the US. It only attacked it as once the same things were done by a Barbados company. So the problem here is not with the functions performed by the foreign company. The problem is that the foreign company moved from the US to Barbados, right? And the judge then go on to say, New ACCO Barbados was the purchaser of the clear-out and was the beneficial owner of the clear-out, acting on its own account upon purchasing and doing all this stuff, because it was a legal entity and it had legal rights and assets, etc., etc. New ACCO Barbados had Jason Mann negotiate an exclusive supply agreement with Albach, and again, this agreement was worth a lot, right? But it was negotiated from day one for New ACCO Barbados. New ACCO Barbados didn't exist then at that time, but I assume, and this is dangerous, that Jason Mann already had in plan to incorporate New ACCO Barbados, and if the contract didn't belong to New ACCO Barbados, logically it should have belonged to New ACCO US, not to the FNA group, because the contract was for buying and selling this stuff, and you couldn't do that through a Canadian company, right? New ACCO Barbados took real foreign exchange risk in its clear-out sales activities because it was buying and incurring related expenses in US and selling in Canadian dollars. The services provided by AgraCity pursuant to the service agreement were largely logistical in nature. They were largely subcontracted by AgraCity to arm's length third parties at arm's length rates. So actually all of this stuff was done not by AgraCity itself, but by third parties that is subcontracted, right? And then the court says, in his rebuttal report, Mr. Rolfe calculated AgraCity's return on costs on a comparable basis as approximately 30%. In his testimony, however, he acknowledged that it would be fair to regard it as more appropriately among being around 12%. And the difference between the 30 and the 12 was that when he calculated the price, he took out the payments between the Barbados company and AgraCity, whereas for third parties you would have included those fees as well, and that's where you come from 30% down to 12%. But of course you need to include the 2 to 3 million that the Barbados company paid to AgraCity every year for its services as well. And the judge concludes, therefore, the taxpayer succeeds in the appeal and the taxpayer wins. I think this is quite an interesting case. As I already showed in the beginning with the real estate and other situations, you know, there are situations where an empty company acquires a right at an arm's length price and doesn't do a lot after that. Arguably not a whole lot needs to be done, and then income or gains accrue to that company, and the question is, should that company keep it under the Chapter 6 doctrine? Or does it have to pass it on? And I'm not sure that it does have to pass it on in all cases. So it'll be interesting to see if the OECD would ever come with additional guidance on the legal ownership doctrine. I hope you enjoyed this case, and I look forward to discuss another one with you next time. Bye for now.